Today is February 24th, 2026. Welcome back to Selling on Giants. This week feels different. Not loud, not chaotic, but structurally important. The Supreme Court just struck down the administration's sweeping Liberation Day tariffs under the International Emergency Economic Powers Act. 6-3, the court ruled that IEPA does not authorize broad, across-the-board tariffs of unlimited size and duration. In plain terms, the 10% baseline tariff and the country-specific tariffs that reached up to 50% under that authority lose their legal foundation. Over $100 billion was collected under those IEEPA tariffs. That money is now in legal limbo. Let's remove politics completely. This is not red, this is not blue, this is operator math. Tariffs change landed cost, and landed cost drives everything. Let's walk through a simple example. You have a product that lands at $10. It sells on Amazon for $24.99. Referral and fulfillment fees are roughly $10. That leaves you with $4.99 in contribution margin before advertising. Now add a 10% tariff on landed cost. Your cost moves from $10 to $11. You just lost 20% of your contribution margin? Not revenue, margin. Now layer advertising. If you were running a 20% ACOS, that is roughly $5 in ad spend. Before tariffs, tight but workable. After tariffs, your break-even ACOS shifts overnight. This is why tariffs are not abstract policy debates. They directly alter allowable ad aggression. Now here is the part most headlines miss. The court struck down IEEPA-based tariffs, but Section 301 and Section 232 tariffs remain intact. And within hours of the ruling, a new 10% tariff was introduced under Section 122, a temporary authority that allows tariffs up to 15% for 150 days. The legal lever changed. Volatility did not. So what does this mean for sellers? First, refunds. If you paid IEEPA-based tariffs directly to customs, you may have exposure to reclaim funds. But there is no clean refund portal, no immediate check in the mail. Trade attorneys expect administrative claims, possible litigation, and potentially a federal refund structure that could take time to formalize. That creates a strategic question. If you receive meaningful capital back in 12 to 18 months, what is it? Margin recovery, working capital, or competitive fuel? Do you reinvest into ads? Do you pay down inventory financing? Do you build supplier redundancy? Those are real operator decisions. Second, sourcing. During peak tariff pressure, brands did not sit still. Many diversified to Vietnam, India, Mexico. Some explored domestic production. That shift required new tooling, new molds, new freight lanes, new quality controls, new minimums, and new working capital structures. Even if rates normalize closer to pre-tariff levels, most brands will not fully reverse those moves. Geopolitical risk is now priced into long-term strategy. That is structural change. Now zoom out one layer further. Tariff volatility impacts valuation. When gross margins swing unpredictably, EBITDA becomes unstable. When EBITDA becomes unstable, exit multiples compress. Buyers discount risk. If costs stabilize and margin visibility improves, brands with disciplined financials become more attractive acquisition targets. Trade policy touches capital markets whether we acknowledge it or not. Now let's run the forward scenario. If baseline tariffs truly move closer to pre-tariff levels, gross margins improve in China-heavy categories. Contribution pools expand. Brands suddenly have room to be more aggressive in advertising. That sounds like relief, but relief often triggers competition. Ad auctions heat up, promotional intensity rises, price compression accelerates, everyone tries to regain share. So the short-term result of cost relief may not be higher profit. It may be higher competitive aggression. That is the second-order effect. And if volatility continues through replacement authorities like Section 122, inventory decisions remain risky, delay POs, and you risk ranking. Front-load inventory, and you increase working capital exposure. The biggest risk is not the tariff itself. It is unpredictability. When policy shifts quickly, brands hesitate. They adjust pricing late, they compress margin to stay competitive, they misalign ad targets. That stress flows directly into marketplace performance. Now let's connect this to another margin conversation happening at the same time. Returns. Reverse logistics has become structurally heavier in e-commerce than brick and mortar ever experienced. Processing, inspection, restocking, liquidation, disposal. Every return quietly erodes contribution margin. AI is now being deployed to predict return likelihood before shipment, flag high-risk SKUs, automate disposition decisions, and optimize routing to the highest value node. Forward logistics has been optimized for decades. Reverse logistics has not. If tariffs compress margin on the front end and returns leak margin on the back end, operators who ignore reverse logistics are operating with blind spots. This is exactly where Bellavix spends time with brands. We have helped generate over $500 million in Amazon sales. We are a verified ad partner. And what we focus on is not chasing headlines. It is building operating plans that convert volatility into clarity. When margins compress, we adjust TACOS targets. When landed costs shift, we recalibrate break-even ACOS. When volatility rises, we protect contribution margin before chasing top-line growth. If your internal team feels stretched between supply chain swings and ad efficiency pressure, that is exactly the complexity we help simplify. You can learn more at bellavix.com. Now zoom out again to pricing strategy itself. Shrinkflation gets headlines, but the smarter move many brands are making is price pack architecture. Same product, multiple sizes, multiple price thresholds, different use cases. Smaller packs protect key price points like $4.99 or $9.99. Multi-packs defend share. On-the-go sizes unlock new occasions. When costs rise, packaging becomes positioning. When population growth slows, brands stop chasing new customers and start engineering new buying behaviors. If tariffs unwind and cost structures improve, expect even more experimentation in pack size and promotional architecture. And then there is distribution. Bath & Body Works is launching on Amazon US. A brand that historically protected distribution and leaned heavily into owned channels is now stepping onto the largest digital shelf in the world. That tells you something. Amazon is no longer seen purely as brand dilution. It is distribution infrastructure. Customer acquisition costs across paid media are brutal. High-intent traffic already exists on Amazon. The real question is no longer whether to be on the platform. It is how to show up in a way that protects margin and brand equity. Control the channel or the channel controls you. And all of this loops back to tariffs, because cost pressure forces strategic clarity. The Supreme Court ruling removed one legal lever. The administration is testing others. Trade friction is not disappearing, it is evolving. For operators, the lesson remains consistent. Separate cost assumptions from strategy. Audit exposure cleanly. Stress test margin models quarterly. Build supplier optionality. Assume volatility. The headline says tariffs struck down. The operator read says uncertainty remains. And in uncertain environments, disciplined operators win. If this breakdown helps you think differently about the week, make sure you are subscribed wherever you listen. Leave a review. Share this with another operator who is navigating the same pressure. I appreciate you being here. This is Mr. Will, and I will see you next week on Selling on Giants.